Good afternoon and welcome back to our discussions on financial statements and business decisions. Business decisions, as we have seen, are financing decisions, investment decisions and operating decisions. In the last few sessions we saw how financial statements reflect the financing decision, and now in these few sessions we will try to see the investment decisions and the financial statements. When I say investment decisions, the options available for the management to use the money that they have raised through debt or equity or any other sources. So the options available for the management may be to make the investment within the business or to make the investment outside the business. And money invested within the business can be invested to acquire plant, property and equipment or the stock of goods, or they can invest outside the business by acquiring investments in other business through equity or debt. But in this session we will try to focus attention on property, plant and equipment. In the process, the focus of our discussion is actually International Accounting Standard 16, which talks about the treatment of PPE, property, plant and equipment. The property, plant and equipments are long-term investments. In other words, they are also called, for example in India, they are called part of the fixed assets. So the issues involved there is what is the measurement at the time of recognition, what is the measurement at the time of subsequent recognition, and what are the disclosures to be made in the financial statements. So that means the cost of acquisition becomes an important issue for recording or recognizing the plant, property and equipment. The IAS 16 says the cost of acquisition is a purchase price plus incidental expenses required and incurred to bring the asset into working conditions, for example transportation, for example taxation, for example the installation expenses. So the cost of acquisition at the time of initial recognition is the purchase price plus all these incidental expenses. The actual payment is not an issue, because acquisition of an asset can result in the decrease of cash flows or creation of a liability or increase in equity. Now let us see what happens in a subsequent recognition. That is important, because the measurement at a subsequent recognition, IAS 16 gives two options or two models. One is called revaluation model, the other is called the cost model. Under cost model, the subsequent recognition is the actual or the original cost of acquisition minus the depreciation for the period. So as a result, the book value of the asset that appears on the balance sheet under the cost model is the COA, cost of acquisition, minus the accumulated depreciation. So what is this depreciation? How is it calculated? What is the rates of depreciation? That we will discuss in the next session. Under revaluation model, they say that original cost is not important anymore. So as a result, no depreciation concept comes into picture. Under revaluation, the asset is revalued every year to reflect the economic reality or ability to generate the cash flows. So as a result, in case of at the end of the year, if the value of the asset goes up, so the increase in the value of the asset because of revaluation is not transferred to the income statement, is transferred to the balance sheet through equity. But if there is a decrease in the value of the asset, to the extent there is an increase, then it can be transferred to the income statement. So this understanding, the decrease in the value of the asset because of the change in the market price, is also called impairment, and there is an accounting standard for that. So as a result, if you see the options available for recording an asset subsequent to the initial recognition, that most company may do either the cost model or may take the revaluation model. So the two issues that comes up from there for further discussion is what is this depreciation, what is the treatment of depreciation, what is this revaluation, what is the treatment of revaluation reserve, and what is this impairment. So these three issues can be discussed in our next session, but otherwise the fixed asset takes a large chunk of the total assets for a non-IT, non-service companies. Thank you very much.